Open your feed right now, and you will see the same urgent promise. A single macroeconomic event is about to move markets, and the push to buy high-growth tech stocks before the clock runs out has reached a fever pitch. The logic they are selling goes like this. Lower interest rates equal cheap borrowing. That liquidity allows companies to expand, which triggers aggressive rallies across the stock market. At the center of this speculation sits the Federal Reserve, the institution that controls the baseline cost of borrowing. They are the ones holding the lever everyone is waiting for them to pull. If a rate cut is truly an inevitable catalyst for a massive tech run, the move is to buy into mega-cap giants today. But if that outcome is obvious to you, it is already reflected in the institutional algorithms handling billions of dollars. Equating a complex macroeconomic shift with an automatic stock market explosion turns a nuanced policy decision into a trap built on the fear of missing out. Financial influencers pitch rate cuts as a reward for the market. History shows something very different. Central banks lower borrowing costs because something in the economy is breaking. The officials making these decisions rarely cut rates to accelerate an already booming economy. They play defense, stepping in to stave off recessions, ease labor market distress, or inject liquidity when corporate credit freezes. When you look at the data from the onset of past rate cut cycles, you do not see immediate growth. You see periods of severe market volatility as companies struggle with the exact economic distress that forced the central bank to act in the first place. Buying the rumor of a rate cut without looking at the underlying economic weakness driving that cut is a reliable way to destroy capital. The loudest narrative right now points directly to AI leaders like NVIDIA and Microsoft. The pitch is that tech companies need cheap capital to build servers, expand cloud networks, and train models. But these specific mega-cap companies operate with a level of financial independence that makes them immune to the cost of borrowing. They are flush with cash and sit isolated from the current rate environment. This chart compares NVIDIA and Microsoft's massive cash against their debt. Generating billions quarterly, they don't rely on cheap Fed loans. Their valuations are driven by surging AI capital expenditure, momentum that exists regardless of interest rates. Purchasing these megacaps strictly because you expect rates to fall means you are paying a premium for a macroeconomic factor that barely touches their actual bottom line. Then there are the consumer-reliant giants, specifically Tesla and Amazon. Here, the argument shifts. Lower interest rates mean cheaper auto loans and reduced credit card APRs, which should trigger a wave of consumer spending. That assumes the consumer is ready to spend. If the central bank is cutting rates specifically because the average household is tapped out and slowing down, dropping the cost of a loan by 0.5% will not revive collapsing demand. This chart shows the historical relationship between falling interest rates and collapsing consumer discretionary spending during downturns. When these lines cross in a rate cut cycle, results are negative. As spending drops faster than rates fall, consumer-reliant companies see their stock prices suffer. Banking on slightly cheaper financing to stimulate a recession-fearing consumer who is already heavily cutting back on expenses is a gamble, not a reliable investment strategy. The final flaw in this retail strategy is a matter of timing. It relies on the assumption that you can simply sit back, wait for the official rate cut headline to drop, and then buy your shares. This flowchart illustrates a forward-looking market. Institutional algorithms purchase the anticipation of an event, committing billions months before the central bank meets. By the time the announcement happens and retail investors buy, institutions cash out, creating a sharp price drop. These mathematical phenomena dictate reality on physical trading floors. Institutions have the capital, proximity, and speed to ensure they are never last to trade. By the time you hear the news, the profit has already been extracted by Wall Street. Latecomers are providing the liquidity for the early money to exit. If trailing the megacaps is a trap, we have to look at what actually works. Where is the smartest place to deploy capital when borrowing costs genuinely fall? The answer lies in the true rate-sensitive assets, smaller companies, known as small caps, and real estate investment trusts, or REITs. A REIT is a company that owns, operates, or finances income-generating real estate. Unlike massive tech firms, these entities lack giant cash reserves and rely heavily on constant borrowing to operate. This quadrant chart maps the landscape. Top left, cash-rich tech giants with low debt reliance. Bottom right, small caps and REITs carrying high debt reliance. Because these smaller sectors operate on thin margins, a reduction in interest rates instantly lowers expenses and profitability improves. Finding true macroeconomic alignment means giving up the social excitement of mega-cap tech stocks. You trade the hype for the mathematical certainty of sectors that require cheap debt to flourish. You are left with a clear mandate. You can either react blindly to financial influencer hype or choose an actual, grounded strategy. For an active investor, the path requires deep research to uncover undervalued, debt-reliant companies. You must actively hunt for the balance sheets that benefit from falling rates, rather than buying into heavily inflated tech momentum. For a passive investor, the smartest move is to ignore Federal Reserve meetings. Turn off the noise and continue dollar-cost averaging into broad market indices, letting the market balance itself out over time. This decision tree outlines the paths forward, whether you choose the active route toward small caps and REITs or the passive route toward broad ETFs. Both paths succeed by bypassing the noise of mega-cap tech hype. Success in these cycles belongs to those who look past the obvious headlines. By understanding what the market has already priced in, you avoid paying a premium for news that Wall Street has already processed.